Hey everybody, welcome. Thanks a lot for joining. My name is Matthew. Today we're going to continue our exploration of the United States money supply. And we're going to uncover the first mystery of M3, that is the market for repurchase agreements, otherwise known as repos. Here we are again. This is the M3 money breakdown for the United States. And a quick reminder how this works. This is cumulative stuff. These consumer or client-facing monetary stacks, which is primarily fiduciary media or bank money. Here's how it looks. The first level, and this was popularized by the Volcker crew and many of the Federal Reserve economists in the 50s and the 60s. The first level is M0. All right, and this is the only non-fiduciary money in the stack. This is base money, state money that is outside of bank vaults. The second level is M1, which is M0 plus sight deposits, or as we know them mostly in the West, demand deposits. M2 is M1 plus less liquid or less regulated retail type savings monetary instruments. And M3 is M2 plus sometimes less liquid, but more accurately, less regulated institutional type monetary instruments. So back to the chart here. Today I'm putting it in red. And now we're not looking at the cumulative figure. That would look different. We're not looking at M2 or anything below M2. We're just looking at M3 money and its breakdown. So as you see in the subtitle there, the non-M2 portion of M3. Okay, this is non-M2 money that makes up the M3 money supply. And very unfortunately, as we talked about in the last video, the Federal Reserve published this money supply all the way until February 2006. Just a couple of years before the great global financial crisis, the Federal Reserve ceased publishing this money supply. So let's answer the question. Why did the Fed stop publishing this broad, liquid, institutional money supply? Let's take a look at the press release from the Fed itself. This first came out in November of 2005. It was last revised in March 9th of 2006. Here it is. On March 23rd, 2006, the Board of Governors of the Federal Reserve System will cease publication of the M3 monetary aggregate. The board will also cease publishing the following components: large denomination time deposits, repurchase agreements, or RPs, and Eurodollars. The board will continue to publish institutional money market mutual funds as a memorandum item in this release. Measures of large denomination time deposits will continue to be published by the board in the flow of funds accounts, otherwise known as the Z.1 release, on a quarterly basis, and in the H.8 release on a weekly basis for commercial banks. And now we get to the crux of their reason. M3 does not appear to convey any additional information about economic activity that is not already embodied in M2 and has not played a role in the monetary policy process for many years. Consequently, the board judged that the costs of collecting the underlying data and publishing M3 outweigh the benefits. Now, I'm going to address two specific items in this press release. The first one is, as I've mentioned before, I find it highly ironic that the institution that is literally in charge of printing the nation's money says they don't have the resources to collect the data. Of course, they say the costs outweigh the benefits, but nonetheless, it's kind of humorous. And the second thing that I want to address is their claim that they're going to stop publishing repurchase agreements. After all, this video is going to be about the repo market or repurchase agreements. So before I get to why that might have something to do with the fact that they stopped publishing M3, let's take a step back. Let's address exactly what a repurchase agreement is. Now, the repo market is a very confusing market for many. It's an opaque market. It's not a very well reported market, but it can be summed up basically with 3 concepts and 4 words. They are, number 1, shadow banking, number 2, liquidity, and number 3, leverage. So let's take each of these items in turn. First, shadow banking. In short, the repo market is made up of non-banks. There are certainly banks that deal in the repo market, as we will see, but they are a minority. Primarily, the repo market is comprised of money market funds, hedge funds, broker-dealers, and even subsidiaries or different legal entities of banks/investment banks. They have traditionally not been privy to central bank liquidity. That is, they don't have the right to lender of last resort central bank money until recently, and we will talk about that. Central bank money, which is a money supply that we haven't addressed in full. Remember, I've talked about M0 a lot, but that is not total central bank money or total base money. Central bank money also includes this thing called commercial bank reserves, which are only available to banks and credit unions. They are not available to the shadow banking sector. So that's part of the reason why you can see something has developed here, this repo market. It is outside of the traditional banking system. Now, what is a repo? A repo is basically the trading of a government/liquid security in a cash-like manner. The security itself trades like cash. That's how you need to think of it. The security itself trades like cash. This is why we classify them as part of M3. But the nature of a repo, the actual economic makeup of a repo, is it's actually a short-term or even more often than that, an overnight loan. So a repo, to revise it, is a short-term loan collateralized by government debt that trades like cash. There are 2 parties to a repo agreement. The first party is what we call the repo party. This is traditionally when we define a repo, when we talk about a repo, when we try to quantify a repo. We're talking about the repo party, or who is taking the repurchase agreement on as a liability on their balance sheet. They're also known as the liquidity receiver. And these are risk-seeking, i.e. return-seeking entities who repo securities. Repo is a verb here. They repo securities, which means they sell treasuries with the promise to buy them back later, often the next day, at a higher price to receive in exchange fast liquidity. And then the counterparty to this, who has an asset, primarily an asset on their balance sheet, they're also known as the reverse repo party. It's purely just the mirror image of the repo counterparty. They're also known as the liquidity provider. These are cash-heavy entities that repo liquidity. In other words, they buy treasuries from the repo party with the right to sell them back, often the next day, at a higher price. And in other words, that will allow them to receive fast interest. So that's what a repo is by its very nature. And then how does liquidity fit into it? Number 2 in the list that I showed at the beginning. Well, in other words, these risk-seeking entities, portfolio managers, hedge fund managers, subsidiaries of banks, investment banks, so on and so forth, the repo party, they engage in the repo market. They enact a repurchase agreement for many reasons, but the overall point is accessing liquidity. This allows them to fill liquidity covenants or capital requirements with some of their counterparties. It allows them to access the funding markets further. It allows them to short other assets and to margin other assets still. The next thing to say about the repo market, which I haven't mentioned yet, and you can probably judge, repos aren't for you and me. They're not for individuals. They're not really retail at all. Repos are a wholesale market, a big bank, wholesale bank. And I know I said that they're non-banking, but again, even subsidiaries of banks deal in repos themselves. that have different legal requirements and different legal classifications than a bank. So basically, repos are wholesale market instruments. And there's a quote here from Zoltan Pozar. He's an expert in this market. I think it sums it up very well. Most repos are responsible for facilitating price discovery in a market-making context, but not funding the real economy directly. So this is not for mom and pops, Main Street, so on and so forth. Repos are for price discovery, high liquidity, and then the third point we need to address here is high leveraged cash trading markets. So let's address the third point, leverage. Make no mistake here, all repos that we're going to talk about are at least 2x leveraged on already existing government debt. By definition, a repo market is at least 2x leveraged, 100% leveraged, if not more, on existing government debt that is out there in the system, in the economy. Let's break this down a little bit. What is being repoed? Again, what is the source underpinning the repo agreement? As I said, it's a liquid government security. So who is liable to pay interest on that government security? It's the government. And remember, we're just talking about the United States here. This principle applies to any market, to any government, to any nation. So the government is liable for interest already on their bonds. But then in the repo market, the actual owner of that bond, the entity that was supposed to receive interest from the government, is loaning that security forward still in the form of this repo sale and buyback methodology. But basically what they are doing is they are leveraging it further. They are collateralizing it further. And they will pay interest on it as well in order to access even more liquidity. So the repo party, or the shadow bank liquidity receiver, the entity that has levered up, collateralized, borrowed against that same government bond, has now become a second interest payer on the same government bond. So let's go back, and we talked about this in the last video. M3, non-M2, M3 money includes large time deposits. It also includes institutional money market funds. We can still derive this number, even if it's quarterly. You have to back into it, and it's complicated in some ways, but I've done it for you. It's right here. We can see that just these two items alone of M3 now comprise roughly $5.5 trillion of liquidity. And if we go back to where they were when the Fed discontinued M3, the tomato here, the red line, non-M2, M3 money was $3.5 trillion, and these two items were about $2.4 trillion. So 70%, roughly, the vast majority of the M3 money here were these two instruments. But then we had this third instrument, which we're talking about today, which are repos, repurchase agreements. And the Fed, up until 2006, when it ceased publication of M3, only included repos that were only on the books of banks and thrifts. And that is here. That's the lightest green shaded item here. You see it still doesn't reach M3. There's another item that's a part of M3, which we're going to talk about in the next video. But if you see repos here, they're not nearly as big as large time deposits, institutional time deposits, as well as institutional money market funds. And really, they haven't grown much at all in the last 16, 17 years since the Fed stopped publishing this data. So let's take off institutional money market funds and large time deposits to where we just have the repos of banks. You see that they discontinued here, M3, and then you see, again, I have this on the timeline. We have the global financial crisis, of course, but then we have the Fed begins publishing more detailed repo data. It's really not that detailed, but it's more detailed, again, in March, the first quarter of 2012, and it's quarterly. Nonetheless, I'm still extrapolating between quarters there to give you a monthly frequency. And you can see it didn't really grow much at all in the banking system. Repos in banks, as I mentioned, this is a shadow banking product. So repos in banks are very, very small. And then you can see, very unfortunate, the Fed stopped publishing. I don't even know, no one knows, except for the Fed, I'm sure, in their archives, the data between February 2006 and March 2012. I'm just doing a straight line linear extrapolation here because that data doesn't even exist. So just assuming that it's somewhere around this level during the global financial crisis. And then it stays roughly the same thereafter. So it's not very big. It's not a big component of the repo market. So what we have to do is we have to see, is there any other source of information provided where we can find this non-bank repo market, this shadow bank repo market? And luckily for us, the Federal Reserve did start publishing with more data, one of their releases here quarterly, as I mentioned, in March 2012. And it's even backwards compatible in some way, shape, or form for the total shadow banking retail market. I am sure that there's even more repos than this. Nonetheless, this is the data that we have about total repos that are US dollar denominated that the Federal Reserve tracks. And I'm going to draw that now. As you can see, this is a big number. This is a big number. Whereas, let's go just to today. The bank portion of the repo market, the banking sector portion of the repo market, very similar to what it was in 2006, $591 billion. The shadow banking portion, money market funds, hedge funds, subsidiaries of banks, investment banks, non-bank entities, they make up $3.1 trillion of the repo market. And that's actually down from $4.2 trillion during the peak of the COVID years. But look back here. Look around the global financial crisis. The shadow banking sector was huge, and it took a huge hit. It was nearly as much as the COVID times. If you look at the repos there, $3.7 trillion, $3,700 billion worth. Just think about that number for a second. $3,700 billion worth of liquid, relevered, recollateralized government securities that someone thought they were going to get paid interest on by this repo borrower that took this much in leverage. It was destroyed after the global financial crisis. You can actually see the plunge during the global financial crisis, where we went from a peak in the repo market in the shadow banking sector of $3.7 trillion down to, in roughly end of 2009, $1.9 trillion. So basically a 50% crash, 50% drawdown here. And it's back up again. But down a little bit from the COVID years. But more importantly, more interestingly, let's remember our tomato line here. This is, and it's painted nice and red so you can see it. This is what the Fed was publishing as M3 up until 2006. Look at where the shadow banking repos are. Thank goodness we actually have this data to compare. Look at where the shadow banking repos are in addition to the bank repos, which they published. In February 2006, you have $2.6 trillion of shadow banking repos, plus another $570 billion of bank level repos. So you're getting, $3.1 trillion just in repos. The Federal Reserve said M3 at this time was $3.5 trillion. This tells me the Federal Reserve absolutely knew what was happening with the repo market. They absolutely knew that the shadow banking sector was growing rapidly, and they had lost control over it. And so rather than addressing it or talking about it, they just canceled publishing the series. Now, you don't have to take my word for this. Let's go ahead and review some comments from a Federal Reserve economist himself. So I'm quoting here from William Barnett from his book, Getting It Wrong, in 2012. And as I mentioned, Mr. Barnett was an economist at the Federal Reserve for decades, as far as I understand, for decades, probably even during the time when Mr. Volcker and crew, he was probably part of this crew, at least at some point, who were developing out these monetary M curves at the Federal Reserve in the 50s and the 60s. He is now the director of the Advances in Monetary and Financial Measurement, that's a mouthful, at the Center for Financial Stability. And they have published a lot of good data as well. Nonetheless, this is how he addresses the M3 debacle of the Federal Reserve in 2006. The cost of supplying the component data was negligible to the Fed. Then why did they discontinue it? I would not presume to answer that question for the Fed, but here might be an unpleasant clue. M3 picked up repurchase agreements, or repos, which were huge elements of the shadow banking system's creation of money. So just in a couple seconds there, he has addressed head-on the first part, where the Federal Reserve claimed they don't have the resources to publish M3, and then the second part, head-on, it was the fact that the shadow banking system was outside of their control, and they had lost control of it, that the Federal Reserve just stopped publishing M3. And, an inconvenient byproduct of all of that was that a couple years later, we had the global financial crisis. Let's follow this on with a footnote that Mr. Barnett wrote about the same concept. Non-banks used AAA-rated mortgage-backed securities, or MBS, in overnight repo trades for cash on a daily basis, effectively creating money from a growing stock of AAA MBS. M3 contained only repos of maturity greater than 1 day at commercial banks, so would not have picked up all of that shadow banking activity. But surely it would have revealed growing repo usage generally. So there you have it. There you have it. A former Federal Reserve economist has basically explicitly stated right there, it was the shadow banking repos that were probably the reason why the Federal Reserve stopped publishing M3, and they probably were a large reason for the global financial crisis itself. And this is not the end of the story for the Federal Reserve and the repo market. So even though we had this vast shadow banking market for repos, which again basically is leveraging up the same government security that the government treasury itself is paying interest on, now you have an additional interest payer, the repo party, the party collateralizing and borrowing liquidity against that security, essentially treating the security like a cash-like instrument to do other things, to short, to margin, all the rest. Not only do you have that market growing here, and by the way, I'm sure it's bigger than this. I'm just sure it's bigger than this. This is the best data we have. This is what the Federal Reserve has tracked, and we can definitely see that it was growing massively already by the time they stopped publishing M3. But it's not the end of the story, because the Federal Reserve here in the post-financial crisis years decided to intervene themselves as a repoer of government securities. And they really started to do it in a big way after COVID. And I'm going to show that right now. This works to be cumulative here. So what I showed you before, let's just take it away. This $3.6 trillion repo market before was actually understated because I'm only counting the shadow banks and I'm counting the banks here. But there's another entity that has repos as a liability on their balance sheet, just like these are liabilities on the other balance sheets of shadow banks and banks. The Federal Reserve as well has a huge liability of repos now on its balance sheet. Let's put it back. There it is. So this is actually the cumulative repo market in the United States as of right now and after all of the COVID liquidity. The total is a little over about $6.3 trillion. And the Federal Reserve's portion now is a huge percentage of that, $2.6 trillion out of roughly $6 trillion are repos that the Federal Reserve itself is repoing, that is borrowing on a short-term basis with the market. Now, the only precedent for this type of intervention of the Fed's balance sheet, remember, this black shaded area here is the Federal Reserve's balance sheet itself. Okay, so we're going to actually have to treat this different in the future. This wouldn't really count as M3 money because it's the Federal Reserve's balance sheet itself. This is more like monetary base money, but it's not officially being counted as monetary base money. We'll get into that in the future. Nonetheless, the only precedent for this type of an intervention in the market was what Ben Bernanke did after the global financial crisis, massively bailing out banks and holders of government paper, mortgage-backed securities, so on and so forth, from failing during the repackaged mortgage-backed CMBS-backed collateralized debt obligation financial crisis that occurred in 2008. Only the Bernanke explosion of the balance sheet, quantitative easing 1, 2, and 3, compares to what happened here during COVID with the Fed entering the repo market. Quick side note, if you find this on the Federal Reserve's balance sheet, they confusingly, as always, call this the reverse repo facility. They're calling it, from the nomenclature, the convention, the perspective of the shadow banks, of the non-banking institutions. For them, it is a reverse repo. For the shadow banks, it's an asset for them. For the Federal Reserve, it's a liability. So I'm keeping consistent here. It's just confusing the way they try to do it. It's unnecessarily confusing. These are all repos. Let's just count it up from the perspective of repos. These are liabilities from those that are leveraging up the securities that they own, leveraging them up and drawing liquidity on them. So the Federal Reserve, it's selling its securities on a short-term basis into the market. It's going to buy them back later with these funds. And in the meantime, it's going to pay interest, the same as any other shadow bank or bank institution in the repo market. So again, look at the total number here. We're at like $6.3 trillion. This is a separate analysis, but at some point, you need to compare this repo market, which is a fully collateralized, rehypothecated version of the government debt market of the United States. And how much government debt is there? That's made the news a lot lately. We've talked about it on prior shows. About $31 trillion at the moment, $31 trillion. $31 trillion of United States government debt. The United States Treasury itself, i.e. the taxpayer, pays interest on that. But then there's over $6 trillion at least, and I'm sure there's probably more if we got better reporting, at least $6.3 trillion or so. There's also additional leverage on that in the name of those government securities that the repo party, that is the Federal Reserve, the whale in black, banks, not so much actually in green, and shadow banks in blue, they are all paying interest again on government debt. So it is full leverage, full rehypothecation, at least 2x on government debt for this $6.3 trillion of government securities. And it's becoming a sizable portion of United States interest, where the interest is being paid twice. It's being paid once by the government, and again, the repo party is responsible for paying more interest on the same amount of debt. Last point I want to make, of course, the Federal Reserve knows a lot of these potential issues. They've commented on them. This is some commentary from the Richmond Fed in September of 2021. They address some of the potential problems. I'm going to read this quote. As with other market intervention by the Fed, large participation in its repo programs raises footprint concerns. A large and persistent Fed presence in markets may alter trading patterns, established relationships, and even technological innovation in unexpected ways, and may create unintended and undesirable consequences. I fully agree with this assessment, and those of you who have been following this channel from the beginning and my podcast before that know that I am a big fan of free market money, of unlevered money, of outside money, such as Bitcoin also gold, silver. They're just interesting monetary assets that keep leverage in check, purely free market money. And I think it's something to keep an eye on because the repo market was already growing like crazy in the shadow banking era, which the Federal Reserve, I think, knew. And I think that's exactly the main reason why they stopped publishing M3, as Mr. Barnett alluded to, and I think clearly agrees. And at some point, they have agreed, even though this is rolled over continuously on an overnight basis, but they have agreed with these shadow banking players that, yeah, we will, at some point, we're going to buy back those securities at a higher price. Now, again, it's when you say overnight, it's kind of a misnomer, right? Because the overnight liquidity keeps getting rolled over and rolled over and rolled over. So maybe they will never normalize it or buy it back. But as of right now, yes, they have a tremendous amount of government bonds that they have sold into the market. Other market players have taken them on, and they are generating interest from the Federal Reserve. And these market players are shadow banks. They are outside of the banking system. So the Federal Reserve now has a huge footprint in a market that it had basically no footprint in when it ceased publishing M3 about 17 years ago. Time will tell what this is going to do to inflation, to money, to the value of the dollar, so on and so forth. The world is changing a lot right now, the monetary systems, all the rest. It's a lot to cover already in one video, but just to show you, the repo market is huge, and it was huge, even compared to when the Federal Reserve was only reporting, let's take them off. Federal Reserve was only reporting this green section back in February 2006. And for the final point of this video, let's add in the shadow banking. Let's not even add the Fed because this could be treated as base money, which I'll talk about in a future video. Let's just leave the Fed off. Let's put back institutional money market funds. Let's put back large time deposits. Now, you're starting to see an M3 money supply, which is continuing. All right, it still definitely exists, even though the Federal Reserve doesn't publish it. You can see the expansion before the crisis. You can see the collapse after the crisis. You can see the expansion during COVID. You can see a collapse after COVID. Although, let's put the Fed back on here. They have boosted that. They have boosted that by entering the market. But again, this is a different type of money. This black whale money here. It's just a different type. So I'm going to leave it off actually for now. And nonetheless, this is fiduciary media that exists primarily in the shadow banking system, what you see in blue, and then in money market funds and banks in the darker green shaded areas. We're at over 9, close to $10 trillion now of non-M2, M3 money. And even in 2006, remember, focus on the red tomato there. That's the Federal Reserve's M3, which they stopped publishing. If you properly count up the repos, we are already, as of 2006, well over the $3.5 trillion that the Federal Reserve published. We're probably about double already in 2006. And having said all of that, having built out all of these curves, having found all of the data, adding back repos, adding back shadow bank repos, we still have one more component that makes up the United States M3 money supply. We're going to address it in the next video. That is the euro dollar. Thanks a lot for watching. Take care.